Okay, let's jump right into this deep dive.
Let's do it.
Today, we're ripping open the latest first quarter 2025 earnings call from ROST stores.
That's right. Known for those dress for less deals, you know?
Exactly. Our mission here is, well, to unpack what happened last quarter, hear directly what management is focusing on, and really understand the key factors shaping their outlook, especially with some pretty significant external shifts happening right now.
Yeah, it was a quarter with some, let's say, positive underlying trends, but definitely overshadowed by some of those outside forces. Let's maybe start by quickly hitting the headline numbers they reported for Q1.
Sounds good. Where should we start? Top line?
Yeah, so first quarter of 2025, total sales saw a modest bump. Grew 3% year over year, hitting $5 billion.
Okay, 3% growth. And what about the key metric people watch? Comparable store sales, comps, stores open over a year.
Right. Those were flat compared to last year, 0% change.
Flat comps. Okay.
Yeah.
And the bottom line, earnings per share.
EPS came in at $1.47. That's just a penny, literally a penny, above the $1.46 they reported last year.
Barely up. And net income.
Actually saw a slight dip there, down to $479 million from $488 million last year.
Okay, so lower net income despite slightly higher EPS. Probably share buybacks helping EPS.
Yeah, almost certainly. And operating margin remained flat year over year, 12.2%.
Right, 12.2% up margin. What's interesting about those results is even though they mentioned a slow start to the spring season in February,
I did call that out.
sales apparently picked up pretty sharply month over month through the quarter. So that momentum meant they actually landed at the high end of their own expectations for Q1.
Exactly. So some positive internal trends improving as the quarter went on, diving a bit deeper into what, drove that performance. Cosmetics was called out, strongest merchandise category.
Okay, cosmetics leading the way. And geographically, any standouts?
They said trends were pretty broad-based across the country, but the Southeast region specifically performed best.
Southeast, got it.
And don't forget DD's discount, their other brand.
Right, DD's, how'd they do?
Continued its strong momentum from last year. Solid sales, solid operating profits. They seem to be really hitting the mark with the value and fashion mix there.
Good to hear. Now, inventory. Always crucial for off-price retailers like Ross.
Absolutely. Total consolidated inventories were up 8% compared to last year.
8%? That sounds like quite a bit.
Well, management explained this was mainly due to making more opportunistic buys, grabbing deals when they see them. That's kind of their model.
Right, opportunistic. But what about average store inventory? Like what's actually on the floor?
Yeah, that's maybe a better indicator day to day. That was up a more controlled 4%. And they said that was right in line with their plan.
Okay, 4% of stores planned. Makes sense. And pack away. Stuff bought for later.
Packaway merchandise was 41% of total inventory, pretty much holding steady with last year's level. So overall, they feel their inventory is well positioned heading into Q2.
All right. And store growth. Still expanding.
Yep. Added 16 new Ross stores and 3 new DD's discount locations in the first quarter.
Okay. And the plan for the full year?
Remains consistent. Approximately 90 new stores total. That's about 80 Ross and 10 DD's.
90 stores. But that doesn't include closures, right?
Correct. That net number doesn't include the 10 to 15 existing stores they expect to either close or relocate during the year.
Okay. Now let's get to what was, well, arguably the biggest topic on the call. Tariffs.
Ah, yes. The elephant in the room.
Definitely. Management clarified that while they only directly import a small fraction of their merchandise themselves,
Right, a very small percentage.
over half of everything they sell ultimately originates in China, which means their vendors are handling the direct import, but that tariff impact definitely filters down to Ross.
That's a really key point. Significant exposure, even if it's indirect. And they stated that, if these tariff levels remain elevated, they're going to be working on balancing things. Pricing adjustments for the customer versus absorbing some of that hit through merchandise margin compression.
A tough balancing act. They think they can manage it.
They believe they have several different levers they can pull to minimize the overall effect. But they were quite clear that short-term pressure on profitability is possible.
Right, possible pressure. But their core goal hasn't changed.
Nope. Still about offering high-quality branded goods at a great value. That's the mantra.
Makes sense. And on pricing more broadly, beyond just tariffs.
They anticipate seeing modest but widespread inflationary pressure across the entire retail landscape, not just them.
So how do they fight that?
Their strategy is basically to maintain a substantial pricing gap below the traditional retailers. Ensure customers still perceive those, compelling bargains at Ross and DD's, keep that value proposition strong.
Maintaining the gap. Okay.
They also explicitly called out that trade policy remains, well, unpredictable. And that requires them to be flexible, make adjustments as needed. It's a moving target.
And this unpredictability, especially around trade policy, that led to probably the most attention-grabbing move of the call, right?
Absolutely.
Yeah.
Withdrawing their previously provided annual guidance.
Yeah, pulling guidance. Why exactly?
They basically explained there are just too many unknown variables right now. It's making visibility into the second half of the fiscal year too limited to confidently provide a full-year forecast. They felt it was the prudent thing to do.
Prudent, maybe, but definitely signals a high degree of uncertainty.
For sure. Interestingly, though, they also reminded listeners that the off-price sector, including ROST stores, has historically benefited when there are significant disruptions in the supply chain.
The chaos is good for off-price theory.
Kind of, yeah. This kind of chaos can create opportunities for those opportunistic buys we mentioned earlier. They seem to suggest the current situation could potentially present similar opportunities. Although this tariff headwind is a new, tricky element.
Right, an opportunity, but with a cost attached this time. Okay, let's maybe dig a little deeper into the financials from Q1 and their specific guidance for Q2.
Sure. Looking back at Q1 operating margin changes, the merchandise margin saw the biggest time. It declined by 45 basis points.
45 basis points. So less than 0.5%. But like you said, on billions in sales, that adds up. What drove that?
Mostly higher ocean freight costs and that initial impact of tariffs, including, costs for goods that were already on the water when the higher rates kicked in.
The goods on the water issue. Got it. What else moved the margin?
Occupancy costs, things like rent, rose by 20 basis points. Distribution costs were up just 5 basis points.
Okay, so some cost pressures there. Any offsets?
Yeah, actually, buying costs declined by 50 basis points, thanks partly, they said, to lower incentive compensation.
The lower bonuses help the bottom line. Makes sense.
And domestic freight costs also improved. They leveraged that by 20 basis points.
Okay. What about SG&A? Selling, general, and admin expenses. Store costs, corporate overhead.
That was flat year over year in Q1 as a percentage of sales. The lower incentive comp helped there too, but that benefit was basically offset because sales didn't grow enough to leverage those fixed costs on a flat comp.
Right. Need comp growth to leverage SG&A usually.
Yeah.
And buybacks. Did they continue?
Oh, yeah. They bought back 2 million shares for $263 million in Q1.
Wow, significant amount.
And they said they remain on track to repurchase a total of $1.05 billion this year, which will complete their current buyback program.
Returning cash to shareholders.
Okay. Now, let's look forward. The outlook for the second quarter, it ends, early August?
August 2nd, yeah. For Q2, they're projecting comparable store sales to be anywhere from flat to up 3%.
Flat to +3 on comps. And EPS.
The earnings per share forecast for Q2 is between $1.45 and $1.55.
$1.40 to $1.55.
Yeah.
And importantly, does that include the tariff hit?
Yes. Very explicitly, that range includes an estimated cost impact from the announced tariffs, which they expect to be between 11 and 16 cents per share just in Q2.
Okay, 11 to 16 cents just from tariffs in one quarter. That's substantial.
It really is. Breaking down the other Q2 guidance assumptions, total sales are forecast to increase between 2% and 6%, which aligns with that flat to +3 comp range.
Makes sense. And operating margin for Q2. If comps land within their projected range, they see operating margin for the quarter coming in between 10.7% and 11.4%.
10.7 to 11.4%.
Yeah.
But how much are tariffs impacting that?
A lot. That projection includes a significant negative impact from tariffs, estimated at a hefty 90 to 120 basis points.
Wow, almost a full percentage point or more just from tariffs. Mostly hitting merchandise margin, I assume.
Exactly, mostly merchandise margin. And they stressed, this estimate is based on current tariff levels. They acknowledged a wide range of outcomes is possible given how unpredictable trade policy is right now.
Understood. Constant caveat these days. If you strip out tariffs, what would margin look like?
Excluding that estimated tariff impact, they'd expect merchandise margin in Q2 to be pretty similar to the prior year.
Okay. Anything else in the Q2 cost structure?
They're forecasting higher distribution costs because they just opened their 8th distribution center. That adds costs initially. Though again, lower incentives are expected to partially offset this.
Distribution costs up, incentives down. Any other assumptions for Q2?
Let's see. Opening 31 new stores, 28 ROST, 3DDs, net interest income around $29 million, tax rate between 24% and 25%, and diluted shares outstanding around 325 million.
Got all that. Now, the Q&A section of these calls often gives some great extra color. What came out there?
Yeah, definitely. Management expanded on that sequential improvement in Q1 comps. They confirmed it was broad-based across merchandise categories, not just one thing.
So things got better across the board as the quarter went on.
Pretty much. And the April business, which performed nicely, was largely transaction-based.
Transaction-based. So more customer visits or more items per basket rather than just higher prices?
Exactly. They mentioned a small increase in average unit retail price, the AUR, but the bigger basket size came from more units per transaction, people buying more stuff each visit.
Interesting. What else in the Q&A? Mitigation strategies for tariffs.
Yes, they elaborated there. Working with vendors for better costing, that's one piece.
Trying to push back on suppliers.
Yeah.
Standard playbook.
Right. Also, implementing cautious price increases, while being really careful to maintain that crucial value gap below mainstream retailers. That's key for them.
Delicate balance. What else?
They also plan to lean heavily on inventory that's already, physically in the country or sitting in their packaway reserves. Much of that isn't burdened by the new tariff rates.
Using existing untariffed stock. Smart. What about changing where stuff is made? Moving out of China?
That's a possibility, but they see that as a much longer-term adjustment, more like a 2026 story, they suggested. It takes time.
Yeah, shifting supply chains isn't quick.
Right. And that Q2 tariff hit we talked about, that specifically includes costs for goods that were already in transit when the rates went up, plus the extra work and costs involved in, reticketing merchandise.
Got it. What about inventory availability overall?
Yeah.
Product flow? Any impact from the tariff chaos?
It's interesting. They noted the tariff changes initially led to some goods getting kind of held up at ports and then released. That could potentially create a temporary influx of closeouts for them to buy.
So a short-term buying opportunity.
Possibly. However, the flip side is that the temporary production halts caused by the initial uncertainty could create a gap in availability after that initial influx.
A potential lull later on.
Could be. But the company feels they're well-positioned to manage the incoming inventory flows in the near term, and they reiterated that whole point about the off-price model often benefiting when the broader retail environment sees disruptions.
Right, leaning into the disruption again. Did they touch on any longer-term stuff like marketing or store improvements?
Briefly. Things like marketing campaigns, store environment upgrades, those are planned as gradual evolutionary changes. Not really impacted much by the current macro or trade policy noise. The goal is to improve the brand experience, drive foot traffic, but ideally do it in an expense-neutral way.
Evolutionary, not revolutionary. Okay.
Yep.
How about the customer? Any changes in behavior noted? Are people trading down?
That was asked. They said comps were fairly broad-based across different income levels. They didn't see strong evidence, not in their data anyway, of a significant influx of customers trading down from more expensive retailers.
No big trade-down effect visible yet. Interesting.
They did note maybe a slight shift towards more functional items versus purely discretionary purchases, like needs versus wants. But overall, customer behavior wasn't described as drastically different from prior periods.
Okay. Any other specific impacts?
One they called out was border stores. Those were negatively impacted by delays affecting cross-border traffic.
That makes sense. What about SG&A leverage? You mentioned they need comp growth for that.
Yeah, they clarified that, generally speaking, it takes about a 3% to 4% comparable store sales increase over a full year to really leverage those SG&A expenses, meaning to have sales grow faster than those costs.
3 to 4% comp needed annually.
Right. But in Q1, they managed to hold SG&A flat as a percent of sales, even with a flat comp, partly because of factors like that lower incentive compensation we discussed.
Got it. Any more detail on specific product categories from the Q&A? Like, why was cosmetics so strong?
Yeah, for cosmetics, they attributed the strength to their team's execution, getting the assortment right and bringing in better brands.
Okay, good execution there. What about women's apparel? That's usually a big category.
It is, and it's been a focus for them. It's now trending pretty much in line with the overall chain performance. So their strategy there seems to be working, and they indicated it's doing so without hurting margins going forward.
Good progress in women's. Any word on children's?
Children's wasn't highlighted as a specific strength, but it also wasn't called out as a notable underperformer either. Sort of middle of the pack, it seems.
Okay, and could they shift sourcing easily between categories to avoid tariffs?
They said it really depends heavily on the specific item and the timeline involved. Rerouting production, finding new suppliers. It's often a multi-month or sometimes even a multi-year process, not a quick fix for most things.
Right. Complex supply chains.
Yeah.
Lastly, price elasticity. How sensitive are their customers to price hikes?
They explained it varies a lot. Depends on the category, the specific item. Is it a functional necessity or a discretionary want?
Makes sense.
Their strategic pricing considers not just the item itself, but also what mainstream retailers are charging and what other off-price competitors are doing. They fully expect broad-based inflation across retail generally.
Which, as they said, could actually help them.
Potentially, yeah, because it can create those disruptions and potentially widen the value gap between them and traditional stores. Their intention, they were very clear, is to maintain their reputation for offering branded values no matter what.
Maintaining that value perception is paramount. Okay, well, that covers a lot of the detail. I think it's time for the segment where we put on our speculative hats.
Ah, yes, the disclaimer segment.
This is not financial advice, let's be absolutely clear.
Crystal clear. Purely for intellectual fun, based only on what they discuss in that earnings call. Imagine you're an analyst trying to cook up an interesting, maybe slightly edgy idea.
Okay, I'm imagining. So think about how much management emphasized the unpredictable nature of trade policy.
They hammered that point.
That significant 90 to 120 basis point tariff hit expected just in Q2.
Yeah, that's a big chunk.
And their explicit reason for pulling guidance was too many unknown variables in the back half, leading to, and I think this was their phrase, a wide range of outcomes given the uncertainty.
Exactly. So one perspective, one angle you could take is that despite management's, long-term confidence in navigating this, the market might not be fully pricing in the potential volatility this unpredictability could cause in the short to medium term.
Okay, so the market might be underestimating the bumps in the road ahead.
Could be. So a potentially outrageous but plausible trade idea stemming solely from that call's themes might be something like a volatility play.
A volatility play. How would that work?
Basically, buying both short-dated out-of-the-money call options and short-dated out-of-the-money put options on ROST Store's stock. A straddle or strangle, essentially.
Buying calls and puts. So betting on a big move, but not which direction.
Precisely. The logic isn't betting whether the stock goes up or down. It's betting that the uncertainty they talked so much about around future tariff decisions, how well their mitigation strategies actually pan out, or how consumers react to potential price changes could lead to a sharper move in the stock price, up or down, than what the market currently anticipates or implies through options pricing.
So you're speculating on that stated wide range of outcomes actually translating into a bigger than expected stock price swing.
Exactly. It's a way to speculate purely on that uncertainty and potential for a surprise, fueled by the very points management raised on the call.
Fascinating. But again, let's reiterate. Just a thought experiment drawn directly from the themes of unpredictability and the withdrawal of guidance discussed on the call. Absolutely not financial advice.
Definitely not. Just an interesting way to think about how that specific narrative on the call might play out if you're forced to construct a trade around it.
A very interesting angle. Okay, as we wrap up this deep dive into the ROST Stores Q1 2025 earnings call, here's maybe a provocative thought for you, the listener, to consider.
All right, let's hear it.
Given management's heavy reliance on opportunistic buys and utilizing that pack-away inventory to navigate this uncertain environment, how much does the success of an off-price retailer like ROST Stores in weathering this kind of chaos really depend on their internal operational excellence versus simply depending on external disruptions creating valuable opportunities for them to seize?
Internal skill versus external luck, or maybe chaos creating the opportunity. It really highlights the unique niche the off-price model holds in the whole retail ecosystem, doesn't it?
It really does. Well, this has been our deep dive into the key points from the ROST Stores earnings call.
And just a final reminder, this discussion was purely for informational purposes. It should definitely not be considered financial advice.
Thanks for joining us as we explored this complex topic. We encourage you, as always, to keep digging and keep asking questions.